Well, there's been a lot of talk lately about gold and silver being at some kind of major turning point because the miners are suddenly producing huge cash flow, visible exchange inventories are getting tighter, China is pulling in silver, and the US consumer is starting to look a little more stressed than the headlines would suggest. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and more confident about what is actually happening in this market. And by the way, today is Thursday, April 30th, New York time. Drop the day and date you're watching from in the comments because I want to see where everybody is following this move from. Also, if you value this type of work, subscribe and comment John A.G. Best below. Keep it simple. That tells me you want more calm, source-checked breakdowns instead of hype. So, first of all, yes, silver has been volatile. I mean, that part is not even debatable. One week it looks unstoppable, and then the next week it acts like somebody pulled the floor out from under it. But that is not a new feature of silver. That is the personality of silver. It moves fast, it overreacts, it scares people, and then, when everyone gets tired of watching it, it usually does something dramatic again. However, volatility is not the thesis. Volatility is just the weather. The thesis is the climate underneath it. And underneath the price swings, we have miners throwing off real cash, physical demand that refuses to disappear, central banks still interested in gold, silver supply still tight on a structural basis, and households still dealing with a cost of living squeeze. That combination is why I think this story deserves more than just a quick chart reaction. Let me show you what I mean. We'll start with the miners, because this is where the general market may be missing something important. Based on recently published company numbers, the largest gold miner reported record quarterly free cash flow of a little over $3 billion, while also producing roughly 1.25 million ounces of gold in the quarter. That is not a small beat. That is the kind of result that forces people outside the precious metals world to look twice. Now, I want to be careful here because I've seen people convert that quarterly cash flow into daily numbers in a way that gets a little too excited. If you divide it across the full quarter, it is closer to tens of millions per day, not over 100 million per day. Still massive. But this is important. The bullish case does not need sloppy math. If the thesis is strong, you can tell the truth and it still sounds impressive. And it is impressive. For years, miners were treated like the forgotten room in the investment house. Everyone wanted software. Everyone wanted artificial intelligence. Everyone wanted the clean story with high margins and no dirt, no diesel, no permits, no weather, no labor problems. But mining is different. It is hard. It is messy. And because it is messy, investors often ignore it until the cash flow becomes too large to ignore. That may be the phase we are entering. If big gold miners keep producing this level of cash, money may not stop at the biggest names. It can move down the chain. First the large producers, then the royalty companies, then the mid-tier miners, then the developers, and eventually the physical metal narrative gets stronger again. That does not happen in one clean line. It happens in waves, with pullbacks, fake-outs, and moments where everyone suddenly pretends they believed it all along. Now, let's connect this to silver. The silver miners are different. Some are not pure silver miners. Some carry a lot of base metal exposure. Some have higher costs. Some are in harder jurisdictions. So we cannot simply say silver price up, every silver miner wins. That would be too easy. But if the better operators start reporting stronger margins, stronger cash flow, and healthier balance sheets, then the market may start asking a very simple question. Wait a minute, did silver miners just become cash flow stories too? That question matters because silver is not just a smaller version of gold. Silver has two engines. It has the monetary engine, where people buy it because they worry about currency, inflation, debt, and policy credibility. And it has the industrial engine, where it gets used in solar, electronics, vehicles, electrical systems, and a growing list of high-efficiency applications. Those two engines do not always run at the same speed, but when they both start pulling, the market can get tight quickly. According to recent silver market outlooks, the silver market is expected to stay in deficit again this year, with physical investment demand rising sharply, even as some industrial uses soften because of thrift and substitution. That last part matters. It means the story is not perfectly clean. Solar demand can use less silver per unit. Jewelry demand can weaken when prices run too high. But even after those offsets, the market still looks tight. So, if someone tells you silver is guaranteed to go straight up, slow down. If someone tells you silver demand is dead because one industrial category is adjusting, also slow down. The truth sits in the middle. Demand is changing, not disappearing. Supply is improving a little, but not enough to make the deficit vanish. And that is why every pullback in silver needs to be judged against the bigger supply-demand picture. Now let's move to inventories, because this is where people can get dramatic really fast. The latest visible exchange data showed registered silver around the high 70 million ounce area. That is a lot of metal in normal human terms. But in futures market terms, it is not an endless ocean. And when registered inventory moves lower while open interest remains large, people naturally start talking about stress. But here's the mistake. A falling inventory chart does not automatically mean a default is around the corner. It may mean metal is being demanded elsewhere. It may mean ownership is changing. It may mean holders prefer eligible status. It may mean the price is doing its job. It may mean several things at once. So we should watch the drawdown closely, but we should not turn every warehouse move into a doomsday prediction. Same thing with gold. Recent trade data showed U.S. goods exports rising in February, and non-monetary gold was a major piece of that increase. That is important because it tells us gold is not just sitting quietly in one place while traders argue on a screen. It is moving through the global system. But again, exports are not automatically panic. They can reflect refining, vaulting, arbitrage, international demand, or ordinary trade flow. So the question is not, did gold move? The question is, why did it move, who wanted it, and what price cleared the market? That is the signal. One more thing we have to include here is futures market mechanics. When volatility rises, exchanges can require traders to post more collateral. Earlier this year, margin requirements for major gold and silver contracts were raised as volatility picked up. That does not prove manipulation by itself. It means the clearinghouse is trying to reduce risk when contract values are swinging hard. But the side effect is real. Leveraged traders who were comfortable yesterday can suddenly be forced to cut exposure tomorrow. That can turn an ordinary pullback into a fast liquidation event. So when silver falls hard after a margin change, I do not automatically read that as the end of the bull market. I read it as leverage leaving the room. And sometimes, honestly, that is healthy. A market that only rises because borrowed money is chasing it is fragile. A market that pulls back, clears out weak hands, and still finds physical buyers underneath it is much stronger. That is why I keep coming back to the same idea. Watch the data, but understand the mechanism. Inventories matter, margins matter, imports matter, minor cash flow matters, consumer stress matters, but no single data point should control your entire view. If you build your thesis on one chart, one headline can destroy your confidence. If you build it on several reinforcing trends, then one scary week becomes something you can actually evaluate instead of emotionally react to. And that is especially important in silver, because silver is famous for punishing overconfidence on both sides. It punishes bulls who use too much leverage, and it punishes bears who assume supply will always appear exactly when needed. The market can stay calm for a while, and then suddenly everybody remembers that physical metal is not the same thing as a paper promise. That distinction is really everything. Now, gold demand itself is also telling us something. Based on the latest demand data, first quarter gold demand, including over-the-counter activity, was a little higher than last year, but the value of that demand hit a record because prices were so elevated. Bar and coin demand was also extremely strong, and central banks still bought meaningful amounts of gold on a net basis. That is not a weak backdrop, but there is a counterpoint, and we need to respect it. Jewelry demand has been pressured because high prices eventually matter. People may love gold, but they still have budgets. And when gold gets expensive, some buyers step back, some delay purchases, and some buy smaller pieces. So again, the story is not one-sided. Investment demand and official demand have been strong, but consumer jewelry demand is feeling the price. That actually makes the market more interesting. Because when a market can absorb weaker jewelry demand and still hold a strong long-term bid from investors and central banks, that tells you the demand base has changed. Gold is not only being treated as decoration, it is being treated as a reserve asset, a hedge, and in some cases, a political insurance policy. Now, China's silver import data adds another layer. Recent market updates showed China importing an unusually large amount of silver in March, far above normal seasonal patterns. The simple version is, China bought a lot, but the better version is, we should ask why. Was it retail investors looking for a cheaper alternative after gold became expensive? Was it manufacturers preparing for solar demand and policy changes? Was it a local price premium pulling metal inward? Or was it all of those things together? I think the last answer is probably the most realistic. Markets rarely move for one clean reason. People want one reason because it makes a better headline. But silver does not care about our need for simplicity. Industrial buyers, retail buyers, traders, refiners, and policy changes can all hit the same market at the same time. And when that happens, the price can move in ways that look confusing until you step back. Now, does China importing a large amount of silver prove the West is empty? No. Be careful with that claim. But does it support the idea that physical demand is real, global, and increasingly strategic? Yes, absolutely. And this brings us to the U.S. economy. Some people want to say the economy is collapsing. Other people want to say everything is fine. I don't think either view is useful. The reality is more uncomfortable. The economy still has strength in places. Employment has not fallen apart. Spending has not disappeared. Recent confidence data even showed one major consumer survey ticking slightly higher. So if someone says every indicator is screaming disaster, that is not accurate. But there is another consumer survey that dropped to a historically weak level in April, and that tells us households are not exactly relaxed either. Consumers are worried about prices, energy, interest rates, job security, and the future. You can see it in surveys. You can see it in credit. You can see it in how people talk about groceries, insurance, rent, and debt. Foreclosure data also deserves attention. Recent property data showed first quarter foreclosure filings up by roughly a quarter from a year earlier, with starts and completed repossessions also higher. Now, that does not mean we are back in a 2008-style crisis. We are not. But it does suggest that pressure is building for some homeowners, especially after years of high mortgage rates, high insurance costs, and stretched household budgets. That kind of environment matters for metals. Gold and silver are not only assets people buy when the world is ending. They are also assets people buy when they start questioning purchasing power, policy discipline, and the long-term value of paper promises. And right now, with government debt high, interest costs elevated, and inflation still part of everyday life, it is not hard to understand why the metals keep attracting attention. If you're successful, share your success story in the comments so others can stay motivated. So, putting this all together, what do we really have? We have gold miners producing major cash flow. We have silver still in a tight structural setup. We have exchange inventories worth watching but not worshiping. We have China pulling in silver at a very unusual pace. We have central banks still buying gold. We have consumers sending mixed signals, not collapse signals, but stress signals. And we have a market where volatility can scare people away right before the long-term setup becomes even more interesting. In my opinion, that means the bullish case is alive, but discipline matters. Don't chase every green candle. Don't panic on every red candle. Don't believe every chart that says the system breaks tomorrow. And don't ignore the slow pressure building underneath the surface either. The best question is not, will gold and silver move in a straight line? They won't. The best question is, have the major reasons for owning them actually weakened? And from what I can see, the answer is no. Maybe silver pulls back again. Maybe gold tests lower support. Maybe miners cool off after strong results. That can all happen. But if cash flow keeps improving, if physical investment demand keeps rising, if central banks keep buying, and if households keep feeling the pressure of inflation and debt, then the larger direction still looks constructive. Tell me in the comments, are you more focused on physical silver, physical gold, miners, or a mix of all three? And do you think the next big silver move comes from investors, industry, or inventory stress? Subscribe if you want more calm breakdowns like this. Thank you guys for watching. I'll see you in the next video. And remember, this is educational commentary only. I'm not telling you what to buy or sell. Use this as a starting point, then match every decision to your own risk, timeline, and financial situation.